Happy New Year, Chris. Welcome.
Hey, Kelly. Nice to be with you again. Happy New Year.
I want to drill down on today's trading action, which I apologize for doing so because I know you're just a big picture thinker, but this is ugly. What do you make of it?
Well, I think we're going to have a tough first quarter. I think, I'll get constructive when the Fed stops hiking, but the Fed's going to stop hiking for all the wrong reasons in the sense of I think earnings will start to slow. I think there'll be evidence that the Fed no longer needs to hike because things are really slowing down. I think that's going to happen a bit faster than consensus. And I think the market's starting to look ahead, not worry so much about inflation, and start worrying about corporate earnings.
Right. So, this gets us back into the old conundrum, which is the two things people say are, well, the Fed can't stop hiking because inflation's so high, and they can't stop hiking because the labor market data is what it is. But you and I know what the future indicators are saying. They're saying both of those factors are going to slow. It's kind of ridiculous. We have to sit around here waiting and pretending like this is not going to catch up with reality.
Right. And then what you'll see next is, wow, I can't believe how fast this has slowed.
Right.
Things have really fallen off a cliff. But it always kind of happens the same way, or at least it kind of rhymes. And unemployment will start to rise last. We'll start to see warnings, I think, about corporate earnings with these reports. I think the fourth quarter will be fine, but the prospective outlooks, I think, will be cloudy at best and maybe downright pessimistic. And we'll start to get those later this month and into February.
The guidance issues and all of that. All right. So you do like Amazon here. And this is a company that has seen probably its biggest revaluation since .com. Why do you think it can, or do you think it can withstand some of the forces you're talking about?
Yeah. So, you and I are negative on the near-term market, but that doesn't mean that there aren't some stocks that have fallen so much that they really discount most of the bad news. And I think Amazon's a perfect example. So Amazon has fallen so much, about 50% from its highs, that it's now selling for the same price to sales multiple it did in 2015. But if you think about it, the sales now are more than half services. You've got AWS, you've got Prime, you've got advertising. And those sales have much higher margins than the sales back in 2015, which were mostly merchandise sales. So, yeah, it's the same multiple, but it's actually worth a lot more. And wow, and it's an 8-year low on that measure. Now, the other thing that's terrific about Amazon, I absolutely love, is they have doubled sales since 2019. Of course, that's the big pandemic bump.
Wow.
But they haven't given those back. There's lots of other companies, Peloton would be the poster boy for this, right, where, sure, they had a big pandemic bump, but their sales are now declining. Amazon sales will grow less quickly, but they're still going to grow. They're going to grow about 10% this year, a little less than that next year, even after this doubling of sales.
Yeah.
And yet the stock is down 50%. They really have a cost problem, Kelly. And if they can get that under control, I think we'd be real winners with the stock.
Great point. Maybe inflation will solve some of that.